We're just waiting for a couple of people, so just a bit of patience. We'll start in a couple of minutes. Yeah, thank you very much for your patience. Welcome to this European Policy Center conference on financing Europe's future, how to mobilize more strategic investment. This has been a project we've been running, which has been kindly supported by the Caisse de dépôt et consignation and NISNO Climate Investments. And we have brought together a task force of around 25 policymakers, experts and stakeholders, and through a number of closed-door workshops, we have come to some conclusions which you'll find in the report, which Philipp Lausberg and Georg Riekeles, my colleagues, have published, which shows the discussions and the conclusions as well as recommendations. For us, this is a crucial topic. We are facing a rather challenging environment, which has a major impact on European policy making, a major impact on the common objectives which we have. But what many of those challenges have in common is that they will require enormous amounts of investment, and we will have to find different ways of both channeling public investment and mobilizing private investment, and of course the combination of the two in the coming years to meet the gap, which is estimated. It's always difficult to know exactly where the figures are, but it certainly is significant. 1.2 trillion per annum is one of the figures which is out there. And it goes right across different policy areas, from green, digital, defense. So it is an enormous challenge, but the European Union, Europe, remains attractive. In some ways, what is happening elsewhere in the world is also increasing the attractiveness of investment coming to Europe. So we need to find ways of channeling that, of benefiting from that, and of making sure that this will lead to the kind of transformations which we need to see. The topic of this conference couldn't be more timely, also in light of the current discussions around the MFF. So in the first panel, we will talk about the MFF and public funding, and how that can be used to mobilize more strategic investment. And in the second panel, we will focus on markets and private investment. And I'm sure we will also make the links between those. Don't worry, in between you get a coffee break, so it's not just talking all afternoon. But I want to thank, firstly, my colleagues for the work they have done, and also the members of the task force for what I think has been a very good project. And then I want to also thank the speakers who will be speaking in today's conference, as well as all of you for coming and engaging with us on this crucial topic. So without further ado, I will give the floor to Maeve Root, who is the Deputy Director General in DG GROW, for your keynote speech. Thank you very much for coming.
Good afternoon, and thank you very much for the invitation. I have, I suppose, kept you a bit here waiting in suspense. It turned out that Schumann is a bit further away from this place than I thought. But anyhow, here we are. And thank you for indeed giving the opportunity to address a very topical issue of how do we make the investments flow better in Europe than we had perhaps had in the past. And in order to make up for my short delay, I promised to show you slides, but only a few slides. So you don't have to bear me reading out the speech, but I try to illustrate the points I want to make now with this couple of a few slides. So indeed, I work in DG GROW, and those of you who maybe have seen us previously mostly as the service responsible for industry policy and SMEs, it's important to mention here that this is the Directorate General now responsible for the current Invest EU program that runs through the EIB, EIF, and a number of national promotional banks. And we are also preparing the future competitiveness fund. So that is a link to the topic today. And of course, from the SMEs and industry policy as well, there is a big demand for investments. So let's take a look. So first, we'll take the next, yeah, please. I wanted to begin by something that you also have referred to, I think, in the work on the competitiveness overall picture, and you are familiar with the competitiveness. Yes, that's better. Competitiveness compass we have put forward as a kind of a mind map, if you wish, to just point out that the road to competitiveness actually has several elements there to make us progress in this direction. And the current Commission is, of course, also working on the fields which you see here around simplification, around skills, for example. But I'm not going to talk about these matters in this conversation, but they are there for the competitiveness. And I wanted to just highlight that these are important elements as well. Now, my talk actually first begins by highlighting something that we maybe don't discuss enough, namely, what kind of economy are we? And maybe there are points which we tend to forget, namely that European prosperity has been in many ways built on our industrial leadership and the innovation that comes with it. And that has been our basis for many years. And we still see that when we look at our export capacity in goods and services, we do remain actually an important global player with our goods that are mostly stemming indeed from our industries. And interestingly enough, also, if you compare services and manufacturing, you see that the industry has performed better than services as to the productivity growth. Now, of course, this is a picture which is also under very strong pressure, because very clearly China is building up a model that is very similar to us, so export-oriented and industry-driven, and with several, let's say, differences in the approach and very lavish funding as well, and maybe a more lax approach to regulation. They have been able to catch up very fast, as we all know. And of course, the geopolitical landscape is very much changing. We see the pressures, particularly from the Chinese rise as an exporting power, with all the overcapacity that they have created. We see the pressures on our European export capacity, but similarly, and maybe even more so, it is manifest in the US capacity to export on third country markets. And this is a trend of sharing goods. So the patterns are changing indeed. And this also then reflects on the other side of the renaissance of the industry policy, which I want to mention here because for us, we see it also as an important element in when we talk about our need for investments and growth. And the industrial policy here should be actually seen as a bit of a overall catch-it-all term. We are not thinking only in terms of manufacturing industry here. We are really thinking in terms of also decarbonization needs. We're thinking in terms of the energy transition to low carbon. So this industrial policy renaissance here catches actually this phenomena of countries taking now the industrial side of things very much more in the center of their policy attention than perhaps in the past. And there we have pretty much just, I mean, this doesn't necessarily show you investment, it shows you the kind of the types of interventions that the countries are putting forward from the policy and funding side. Now, just again on the overall landscape before we get to the budget number itself, we are looking at how can we create and deepen the markets. How can we support industry, including manufacturing industry and the related services and the related innovation in Europe, including cross-border work. And then we are looking at also rather down-to-earth projects. And what this slide tells you is that on one hand, we look at single market, we look at our economic security. So these are all lines of work that this Commission is busy with. They will create more demand in Europe. Then you look at the middle list with the InvestEU, Competitiveness Fund, the future one, and then the reform in public procurement, which we plan. IPCEIs are the famous important projects of common European interest, which is a way for member states to come together around a certain thematic topic of technology development, be it hydrogen or be it batteries. Then, of course, Horizon Europe is providing important funding for innovation. And then we have the Savings and Investment Union, which we do expect actually really move things forward and make particularly venture funding in Europe more easy to obtain. And I still wanted to show the right-hand side as well, since this is a relatively new approach we are taking in the Commission, putting forward really frameworks and facilitation for strategic projects. So these are the critical raw materials. There is, of course, an act, there is a regulation as well, but underneath is also a drive to create important strategic projects. And that's where finally the funding should also flow into. And net zero industry similarly, and Resource EU is again reinforcing our drive to have raw materials availability, be it from direct raw materials or recycling. Now the next budget. Let me now see if I have. Yes, indeed. I have the European Competitiveness Fund budget here, and people sometimes get confused. I must say that maybe the way we presented it could have been clearer, but I put it here in front of you so that you can grasp what is meant by it. If you think of the next MFF, the next budget, it comes with several chapters. Now, the envelope or the chapter which is for competitiveness has its overall setup as you see here. And several existing funds and sources come together under this competitiveness heading. And then we have the yellow part, which is a part that is directly covered by the European Competitiveness Fund regulation. And the yellow part, in fact, is a bit of an interesting source, because you also see a little yellow slice in the bottom, and the yellow slice in the bottom very likely will take us actually maybe 1 or 2 rounds around the whole ECF here, because the slice you see with a size of about 10-11 billion euros is going to be leveraged and magnified several-fold, at least tenfold. And I'm looking here at Merete and colleagues from EIF who will give us testimony hopefully later. We have also achieved leverage even to 15 times and even more, thanks to the way how we use the capital. So this yellow part is not meant to be paid out as grants, but is meant to be kept as a guarantee capital based on which we can then offer financial instruments and leverage it several-fold, at least tenfold is a current plan. So we would say, of course, from the hat I have on from DG Grow side, that the yellow part should actually be a bit bigger, because then we really get leverage and we are not paying it directly as grants from the budget. But currently it is what it is. It's about 10 billion for the guarantee capital of the fund. About 1 billion will be for all kinds of admin costs and whatever related to it, and also advisory services and support to investments. And then the rest what you see here is, of course, a very important program for Horizon Europe, which is almost double the size of the current one. And then you see the other windows which we have under the Common Competitiveness Fund umbrella, where the idea is to make them work much more together in a harmonized way with one rule book, so that the projects could be treated, I would say, in a more equal funding, and that we can combine and blend our tools better than we manage today. And now if I more closely look at the ECF, I mean now already the yellow part, we zoom into the yellow part, we left now the other elements out. Then you see the windows, thematic windows. Again, you recognize they were the same things that you saw here, under the yellow here. Now I go in and you see the planned size of these windows, so thematic windows. In order to program the content of these windows, we will rely a lot on the DGs which are responsible for these policy areas. And we will, of course, work with our stakeholders, and we will work with member states to see what should be the spending priorities within these thematic windows. And then now the Invest EU instrument, the fund, you see also as a horizontal measure, because this can be used for any of the thematic priorities. And we'll put forward common rule book and common governance. And then, of course, you see on the left-hand side the idea that with this combination now, I should actually say that the Competitiveness Fund windows replicates the logic of Horizon. So within Horizon, you also have a pillar where these 4 thematic windows are designed. So the idea is that within a window, let's say, of, health and biotech and agriculture, there will be a window from Horizon side combining with a window from Competitiveness Fund, and they come together so that we really can ensure this seamless journey, as we describe here on the left-hand side, from research to deployment, so that companies are not artificially kind of pushed from one program out and then they have to find a way to another. We will try and create this seamless joined up approach within the same Competitiveness Fund structure. So that's what is the Commission proposal out there, and the debates are, of course, ongoing in the Council, in the Parliament. We have voices in favour of this approach. We have those who are concerned. But altogether to say, I think this really would take us forward quite significantly. And my hope is that we finally manage to overcome one of the shortcomings that comes from one report to another, that Europe doesn't manage to get our research results to the market. So this combined structure should really help us forward, also taking the taking the results to the market. And thanks to these various financial instruments, we should also facilitate venture and risk capital getting to European markets. I stop here because we have a panel coming, and I'm sure the debate will reach what I have said here. Thank you.
Sophie Barbier, who is Director of the European Affairs Division of the Caisse de dépôt et des consignations. Then we have Rasmus Nordqvist, who is a member of the European Parliament for the Greens. We have Cornel Ban, Associate Professor at the Copenhagen Business School. And, of course, as you just heard, Maive Rutte, who is the Deputy Director General of the Freudian slip, not of the European Policy Center, but of DG GROW in the European Commission. But I think this goes to say that here at EPC, we feel we're very close to Schuman, even though it is a walk. Well, this first panel, towards the next MFF, how can the EU mobilize more investment for strategic goals? Fabian said it in his introduction. A lot of us certainly will agree the European Union is in a decisive moment. At the same time, we have seen an EU over the past decade that has become much more active in using its budget to pursue strategic objectives, from the green and digital transition to industrial resilience, now defense and economic security. Still, I would say expectations are rising faster than resources. So now as discussions on the MFF are intensifying, a central question obviously is emerging, and that is, can the EU mobilize sufficient investment for its strategic priorities? And how can it do so? Can it do so without relying only on a larger EU budget? And as you've clearly explained, Maive, this debate goes much beyond simply spending levels. It touches on the design of EU instruments, the balance between grants, guarantees and equity, but also the form of leverage that can be deployed through InvestEU, the role of national promotional banks, the role of private capital, certainly, and mixed with that all, obviously there are important governance questions that come in that are at the heart also of the interinstitutional discussion. So this panel brings together, I think, precisely these perspectives, needing to unpack these questions, the questions of EU-level policy design, of parliamentary oversight, economic analysis, financial implementation, and of course, independent strategic reflection. I think over the next hour, what we'll try not to do is to sort of simply rehearse positions, but try to explore where the real opportunities and leverage lies, what needs to change, including in the proposals that have been put on the table, what trade-offs are unavoidable, and where consensus may realistically emerge. I wanted to start with you, though, Maive, just sort of a short follow-up question, because you sort of hinted at it, teased us a little bit, the story of leverage. I mean, I'm the first to say that I think the MFF proposal overall is a brave proposal that's been put on the table in terms of how it does refocus priorities, not least on competitiveness, attempting to deal with some sort of the older elephants in the EU budget that have centered or taken a lot of the money in the past, but also this merging of programs into a single rule book. But when you look at your slide, you're wondering if you're saying that these 1 billion, these 10 or 11 billion can mobilize up to 1 trillion. Why on earth would one put on the table a proposal, MFF proposal, out of which you only have 11 billion that you're using for leverage and not much more?
Well, I do think that this question goes beyond my pay rate, but since you almost graduated me to Deputy Director General in the Commission, let me try and respond. Well, I think what we see here is, first of all, that this is already a powerful opportunity. And we, in a conservative way, say, look, it's most likely going to be tenfold. But we have examples, and I'm again pointing at Merete here, Merete Klossen, who is our deputy chief in the EIF. We have an interesting example, for example, currently running the equity, one of the facilities where we have reached even 19-fold leverage. But then you have other tools where the leverage is not necessarily so high, so we have to be nevertheless cautious and not overpromise on the financial instruments. So first is to say, if things go well, we may indeed manage to use this 10 billion even beyond what we currently, let's say, risk calculating. Secondly, we also have used the current InvestEU, which is our, I should say, the example of building the next fund. We have used it on the very flexible and open way, meaning that other programs can always use the financial instruments as a way of channeling and implementing their policy. And this is what we are currently offering all these thematic directorates or DGs who are responsible for a certain thematic field. They can always use our financial instruments as a way of multiplying and leveraging the capital. So they can take part of their window allocation and shift it to the fund and then have it leveraged through national promotional banks, EIB and EIF. So this remains open. And by the way, also member states, and they do so. We have a very interesting member states compartment also in the same current InvestEU setting, where member states are channeling some of their, for example, RRF money, and then again benefiting from the financial leverage and outreach through EIB, EIF, and national promotional banks, well, mostly EIB, EIF.
Excellent. So what you're saying is that what you put on the table is a tool that can be used, an instrument that can be used through different ways. And then it's the question of political choices, how much one wants to use it.
Exactly.
Political choices, the level of member states, political choice also at the level of the European Parliament. And I think that's a perfect segue to you, Rasmus. You are a member of the European Parliament, so a lawmaker that certainly plays a role in these discussions. So can I sort of ask a general question to you to start? Sort of what is necessary now and maybe political feasible now in this new MFF that wasn't so 5 years ago? And sort of to add to that question, when you look at the MFF and this question of what's necessary and political feasible, to you, what is the single biggest obstacle to mobilizing more investment? Is it the question of political agreement on what to do? Is it the lack of money, or is it the lack of leverage, or how we use leverage?
Well, thank you. And first of all, I mean, what's necessary and what's feasible is rarely the same when we talk about politics, and especially not the MFF. I mean,
that points to we need more money.
But not only. I mean, money is going to do a lot, and I will for sure advocate that this MFF, it's pretending to be much bigger, but if you go down in the numbers, it's more or less the same as we know. So it's not this big new strategic approach from the Commission. It's payback of loans, and then it's more or less what we know, but in a new structure, which I'm actually quite happy about, because I think this new structure can something. But then again, the strategic choices that was needed hasn't really been made. And we see that with the national regional partnership plans, where there was a flexibility. It's been eaten up in the last 2 weeks by the Commission itself, by putting more money to core policy area like agriculture, which is also needed. So size, yes, we need more money in order to be able to actually invest. But what we also need is to understand we're not going to do this investment needed in Europe by public money. It's about doing things from public side that will attract the private investment, because we have a lot of money in Europe. And that's also what we need to see. I mean, the private money is there. We just need them to stay in Europe and not go everywhere else. So I think that the the need where we have to work right now, and we started all of a sudden talking about a little corner in one of the headings, but it's actually a design of the overall, how do we fit and actually make strategic choices with this MFF? And that's the problem as I see it right now with the Competitiveness Fund, is it's talking about strategy, but not really making the choices or making clear how to make the choices. Because if we want to attract the private investment, it's not the public money that's going to do it. It's a mixture of public money and the right regulation goes with it. So a work plan of where do we go? Is it the decarbonization, for example? You can't really see that as a priority because it's quite minor what's been put aside in the Commission proposal. But if it was, and I would say it was needed, then they also need to be followed up with the right regulation, so we attract the money. Because again, the money are there, but why should private investment follow public money? For example, batteries in Europe, if we put money into it, if we don't have a regulation saying we need European batteries. So the work program idea of where the mix is between the fund and the whole regulation around that, and then the work programs needed to do the right regulation going with it, that's the missing part. So I think we have some design issues before we actually talk about the size of it.
So you're also pointing to that we're working on an instrument that has a use. You would wish we would have more money, but that's politically difficult to discuss.
Never if you ask in the parliament, that's just in the council, that's an issue.
Absolutely, that's true. But what you're really pointing to is, because our conference today is about strategic investment, what you're saying is that, in a sense, I'm simplifying, but sort of investment tools, we can do that, but it's the word strategic that's missing. And where does that come in? Does that, because Maive started with, in her slides, if I remember correctly, a slide about the competitiveness compass. Is that where it comes in? Or is it something broader? We also have the Industrial Accelerator Act. There are discussions about made in Europe terms, European preference in public procurement. Is it this whole set of policies now that must come together in support of strategic investment choices for Europe? So that's your argument.
That's my argument, but also that we actually dare having the discussion. I'm not saying this is going to be easy, but strategically, where is it we need to go in from EU side in order to be competitive? I mean, we actually want the decarbonization. I'm sorry, we're not going to do that with putting aside 26 billion in the competitiveness fund, because it needs to be followed up with much more. So if we make that strategic choice and saying, if we want to have European businesses in the coming years actually be competitive on a global market, then we need to roll out the way for that, and not just saying we put a little money there and then we also put the money on digitalization. We also put some money here, and the most money we put into to core issues in the national regional plans, and we put it into defense. There we're missing out on actually, if we want to be competitive, what does it take? And I think it's a bit like everybody is pulling out Draghi report every time we talk about this, but we read every 10 page and not really saying, okay, that's a report, that's an analysis, and then we need to do the political work afterwards, saying go down and make some choices. And that means that yes, for some value chain, some industry, parts of Europe will be winners and other will not, and then there are other areas where it will be the other way around. And that discussion cannot be initiated when you look at the council, for example, because there you have member states sitting looking with the member state angle. I mean, I come from national parliament before European Parliament, so I mean I know that side. But we need to dare to make. If we talk strategy is also about making choices. You cannot have a strategy saying we want it all, a little bit, perhaps. And that's what I think we're doing a bit with the Competitiveness Fund right now.
So dare to make choices, dare to take risk, then dare to lose, dare to pick winners or try to pick winners, go for certain technologies rather than others. Cornel, can I sort of push that question over to you? I mean, I don't know the full range of academics on investment and strategic investment in Europe, but I know some of your work, and you've been writing very interestingly on comparisons with China, and you told me earlier that 2 years ago China was a black box to us in terms of how they were doing investment, and we didn't really want to look at it because we didn't want to see what was happening. Whereas now there's a huge interest in China's model of government guidance funds, sub-funds, etc. How did China capture the EV batteries market, for instance? How did cattle become what they became today? Can you sort of describe a little bit what you've seen studying the China's public-private investment model and why it has succeeded, and what you take from as lessons from that back home to Europe?
All right. So, I mean, there was tons of good research on China before 2 years, but it didn't really filter into the policy space and the financial media as much as it has in the last year, thanks to, I guess, the U.S. administration. So, one thing here, if I could perhaps rephrase your question and ask, what would be a Chinese planner's view of Europe? At this point, and I'm talking about a Chinese planner's NDRC member who is really schooled into the political limitations of the European policy space, not somebody who just extrapolate. And I would answer your cattle question very directly. And I think a very smart Chinese planner who would be flown in Brussels to offer policy advice would say, all right, so if you want to get into batteries, you probably need to give up or do something very drastic. And what would be the 6 drastic things that they've done that could travel in our system without a lot of political editing? All right. So just looking at China as a plumbing structure rather than as a political policy space. The first one is, apropos of what Maive has said, I think that 11 trillion in China is a lot bigger. Okay, the 11 trillion is about 11 billion is about 9 times bigger if you add up all the scale-up funding for that particular stage of the value chain, and it is less on the manufacturing and infrastructure side than it is in our case. That's the first numerical difference. So just to bolster, the Chinese planner would say, you know, you guys are not taking enough risks on the scale-up. We're doing a lot more than that. Second, the Chinese planner would say, we understand the political limitations of roping in Viktor Orban into some kind of pan-EU system of mobilizing the EIF-EIC complex as a kind of fund-of-fund structure, and have a coalition of the willing in 6 or 7 member states, whereby the counterparts to the EIF, which in China would be provincial funds or sub-funds of what they call guidance funds, which are basically publicly owned funds of funds, and see how much that works, and then try to scale up. Don't change the paradigm before you experiment. And we have 38 regional funds of funds in Europe, owned by regional authorities. We have a very large number of nationally owned funds of funds that work with the EIF. They do not have sectoral targets. So in order to have the level of coordination between what the Commission wants and the member states do, the kind of planning logic would be that alignment will never happen unless there is sectoral targeting in the portfolio of the national and regional funds that are the counterparties to the EIF and EIC. That will be the second lesson. All of this was very important in the rise of China's EV sector. I could provide more details on that, but I care more about the macro financials here. The third would be on Maive's priority on sustainability. The Chinese panel would remind the European Central Bank that they promised green TLTROs when the inflation rate goes down. Christine Lagarde tried to do something similar to her counterpart in China. They've been running since 2018 a program whereby the central bank reduced the cost of capital for green deep techs by 30%. So they have a 8-year lead on reduced capital costs for the entire green ecosystem, on whose back they scaled up digitalization right? And deep techs in related manufacturing sectors. So this is how they were all connected. 4, on the grant side in the budget, tighter performance conditionalities on beneficiary firms. In batteries, CATL would not receive preferential treatment if they didn't extend the range of batteries year by year. So now we end up with batteries in China, with chargers in China. They can charge a battery in 5 minutes for 600 kilometers. They're aiming for 1,000 kilometers. It will be very, very difficult to compete with China under conditions in which our conditionalities at both the member state level and the MFF budget are a lot less constraining. So paradoxically, in a sense, China has more ample funding, much more generous funding, but also much more conditioned in terms of the technical performance of the beneficiaries. The 5th, think about, and this is very sort of unsocialist. I mean, think about non-MFF funding, right? And a lot of the equity in these state-owned funds comes from very large SOEs that we have in Europe, energy companies, infrastructure companies, tobacco monopolies. So forms of what in China is called stale capital that they convert into risk capital. So instead of dumping all the dividends from state-owned firms into the common budget, you take a percentage, say 1 or 2%, and that becomes equity in funds of funds that then have their own sectorally specific sub-funds. And that gets them a lot of conversion rate on what would be otherwise, a dull fiscal resource into massive source of risk capital. And finally, they would think really hard. They'll say, think really hard about, if you want resilience, think about critical raw materials. And be lucid about it. It does not, we have not been successful, the Australians have not been successful at smelting the critical raw materials in a privately owned company. Even the Americans, the Department of Defense, is now majority shareholders in germanium companies. They just bought one last month in Texas. So we have to, when we talk about critical minerals sovereignty, we have to accept the fact that even Trafigura in Australia, who know their business, were not able to make money on this. So this would be the 6 lessons. Now, to sum up,
say on the batteries, CATL was producing phone batteries in 2014. So and Rasmus was pointing to
2012, 2014. Yes,
2014. Correct. The need for sort of the whole set of policies around it, including making choices, maybe also
some very hard choices.
You sort of touched upon it. You said about sectoral targeting, but is there something more in their drive that has accompanied their investment vision and industrial growth?
Yes, the number one thing is the management of demand. I don't know how we do that in Europe, other than thinking about how procurement is rewired. And they've used procurement in an experimental sense. But the most important thing, and that's not an easy lesson for Europe, right? How much there is this debate on made in Europe now, but China effectively had the white catalog in 2016 that reduced public support for batteries made in China by Chinese OEMs. The market was Japanese and Korean, and then it became entirely Chinese. But that's not the thing that actually landed them the success. The success was that they managed the demand for EVs. I mean, that's the critical thing. And the way that was done combines a kind of Gaullist French dirigiste logic, of 5-year plans with targets on new energy vehicles, how they call them, on the one hand, with a very kind of Schumpeterian liberal logic, which was that extremely high levels of competition. I mean, you have almost 100 car companies in China. They are incentivized to go into price wars. And then, of course, the price for everything goes down very, very quickly, which enables them to be then very competitive against us. And it's not the subsidies. I think the Commission's emphasis on the subsidies kind of obscures the sources of the success. They've done the subsidies at the beginning. I'm not saying that didn't matter, but it doesn't explain why China is technologically advanced in the EVs, why they're on the frontier, why our companies are going to China and become... Stellantis is the main shareholder in Leap Motor, which is one of the top producers. BMW owns 3% of XPeng, which is a market leader. They go there because the technological frontier was not engineered through subsidies. It was engineered through a macro-financial system of risk-taking, but also dirigism and planning, that generated a very local chemistry that's not Soviet, is not China in the 2000s or even 2010s. It's something very, very different. And we need to study that very closely.
Excellent. So you are, in a sense, pointing to the same thing as Rasmus, saying that there's a lot of strategy that's needed together with a lot of market, and you're pointing to sectoral targets. Of course, you're pointing to scale, and you're making a comparison with Europe in terms of, you say also in Europe we have a number of sub funds at regional and national level, and that's sort of makes me turn the question to you, Sophie. You represent one of Europe's most significant actors in this field as the CDC, as a national promotional bank. I think you have a balance sheet that, am I mistaken, that significantly outsizes that of the EIB. So this is huge. How do you, as a French national promotional bank, see yourself fit into this architecture? And do you agree with the need for guidance, clearer direction in terms of where and how money is spent, and how do you see that being possible in a sort of an open architecture where InvestEU says, well, actually, for our implementing partners of this leverage effect we want, we can turn to the EIB group, we can turn to the French National Promotional Bank, or the German, or the Italian, or the Polish one, or we can even have private actors. How do you analyze this?
Thank you for the question, and I was really interested to listen to the previous speakers. I think, first of all, we should be careful with terminology. In fact, it's a little bit... I thought that you were going to say that we were a big fund. So my first remark would be that we are not a fund as a national bank. Alors, we are even not a big promotional bank. We are a promotional institution. So we are not necessarily submitted to the same constraints as banks. But what I mean is that I find the comparison with China very interesting, but I'm wondering whether the comparison between, for instance, EIF being a fund of fund as the Chinese fund of fund is correct, because I think we are, it's some kind of EIF. It's a different model, in fact, and so the comparison does not hold completely. And I assume, I'm not a specialist in the Chinese economy, that it is not completely comparable with the way the European economy functions in terms of what we call private, for instance, private funds, things like that. So, first of all, I would be careful about these terminology issues. But indeed, you are right, Georg. We as national promotional institutions, CDC, but also our colleagues, KfW in Germany, GDP in Italy, and we are more than 30, in fact, across Europe. We have to play a bigger part in the implementation of the MFF. And I think that in this respect, the Commission proposal is also, from our point of view, a good proposal. I think we should not only focus on the question of architecture. And I think that in the current political debates, there are a lot of discussions around national plans and the competitiveness fund. Well, it's indeed a new architecture, but what is important is what Maeve said in her introduction. It's the fact that the Commission is willing to trigger more leverage. So in this respect, this is a very interesting proposal. It builds on what we are already doing under the current MFF, and so it is promising. It is promising, even if indeed there are some things that could be improved, but I will come back to that, because your first question was, how do we fit in this architecture? I think indeed it is already in the proposal of the Commission. We are mentioned, the different implementing partners, international financial institutions, national promotional institutions. So we have a key part to play. Concerning guidance, yes, I found also very interesting this, once again, it's about words, but this idea of a competitiveness compass, because what we need is a long-term perspective. So I fully agree with you, Rasmus. As financial and economic players, we need clear objectives and stable objectives. And we are living in a world where uncertainty is really something that is maybe the main obstacle to investment. So Europe is maybe a haven for stability, and in this respect, clear objectives, stable and simplified regulation, and efficient instruments are key if we want to have more investments with this budget, the next budget. So in this respect, yes, political guidance, we as implementing partners, we are not legitimate to say what has to be financed or not. Of course, we are long-term investors, so we take into account externalities, but that's a financial approach. So indeed, we invest in green projects because we know that in the long term, these green projects will be the good projects. So it's just for financial reason. It's not a political one. And we do not discuss political objectives. We need them. We need them to be able to support the policies.
But do you feel that they're lacking? I mean, if when one is immersed in the policy bubble here in Brussels, I mean, it is about the green, and digital. Now it's about economic security. It's about technological sovereignty.
No,
sort of this doesn't.
I think that compared to other economic zone, maybe not China, we have quite clear objectives, even if, of course, they adapt to the environment and the global environment. I would say rather that we should be careful not to discuss only in the next MFF the political forces should not discuss only about objectives, but also about implementation. So implementation is key. Implementation is not a technical issue. Implementation is what will allow the budget to leverage on other sources of financing. You asked the question of whether it was a lack of money, but of course, yes, but there will be always a lack of money. And even if the parliament gains in the negotiation, there will be not enough public money to finance the investment gap, of course.
How do you provide leverage? How much do you get out of 1 euro?
I was coming to that.
What kind of tools are you?
Leverage, it's what we can do if we, with the type of instrument that Maeve presented, that is to say InvestEU. So the InvestEU instrument is important. It's a guarantee. How does it work? It's a budgetary guarantee. So first of all, under the current MFF, there is only 40% in the budget, and it will trigger for 40 to trigger 100 million of guarantee. When it comes to the implementing partners, we are financing, for instance, 200 million with the 100 million guarantee. And then when we are in a project, of course, private investors, private financiers will come to the table. And so you will get this leverage effect. If I come back to the example of CDC, for instance, with InvestEU, we're able to have a leverage effect between 5 to 19, indeed, depending on the instrument. With debt, you have of course, lower leverage effect. With some kind of indirect equity, you can reach almost 20 leverage, 20-fold investment compared to the initial public euro put into the project. So indeed, leverage is important. And if I can just finish by maybe commenting, I said that there were ways to improve maybe the proposal of the Commission. It's indeed concerning one of the improvement concerns InvestEU. Because in the proposal, Maeve referred to 11 billion. In fact, with comparable figures, it is half the amount of the current InvestEU guarantee. So, on the one hand, the Commission is saying that they want to leverage more the budget, and on the other hand, the instrument that can be used to do so is halved compared to the current MFF. So here there is a contradiction. This contradiction is partly resolved if we consider that programs can top up this instrument. It's indeed a possibility, a flexibility in the next MFF, but will they do so? Will they do so if you have no incentives?
So you're saying we need a much bigger InvestEU guarantee at the basis?
An initial amount, yes, and mechanism to make sure that the other programs will also turn to this logic of financial instruments.
Financial instrument. And Cornel was talking about China doing something 9 times bigger. So those are interesting figures. Now, Philip, turning to you, I mean, you've looked at the competitiveness fund in much detail, and also putting proposals on the table for how the proposal can be improved. How do you see this whole risk-taking exercise, if we can call it that, at the EU level now? If you sort of dissect the competitiveness fund, are we doing the risk-taking we say we are doing, or think we should be doing?
So let me start by saying that risk alleviation should be the main goal of this fund, because I mean it's about crowding in more funds from outside, so private investors, but also other public investors or semi-public like promotional banks and so on. So it's really about getting more bang for the buck, so to say, to really make this budget mobilize much more money than it actually has. And as Sophie has already said, I mean I agree, the 11 billion it's not enough. If you look at the whole fund, it's 234 if I'm not mistaken. I mean, all the other money, I mean, of course, you can top up in the work programs and so on. But I mean, where are you going to spend all the other money if it's not leveraged? I think most of it should be leveraged. And then the question is also, how do you leverage? I mean, you can go leveraging means you go in breadth. You have more money coming in, but is it the money that goes in the right projects? That's the next question. And here we really see that so far, I mean, InvestEU has been successful. It has these amazing multiplying rates and all of that, but it didn't always go into those strategic areas that Europe needs funding most in, and that is, scaling up breakthrough innovation, infrastructure, mining, and so on. So I think because there you need a very, very high de-risking rate for the private sector, but also for other public investors to go into. Otherwise, they're too risk averse to do so. And
explain the de-risking rate. Does that mean that when we're giving money to an implementing partner, they are not bold enough in how they're using that money in support of the real economy? Is that what it means?
It's a mix of that. So on the one hand, you have implementing partners who are not always as risk averse enough to invest in these things. A lot of them are AAA rated. EIB Group is a case in point here, of course, and also for good reason, and it has its own logic, of course. But that also keeps them away for going into more risky endeavors. But on the other hand, what the EU can do here is increase the provisioning rate. That means how much of a guarantee, how much of a loan is guaranteed, how much of a financial guarantee instrument is guaranteed, what kind kind of financial instruments are used. And I think there, of course, something can be done too. And we've seen in the proposal for the competitiveness fund that here, the provisioning rate has been raised from 40 to 50%. I think that's very welcome. It also leaves it open the possibility to further raise that. I think that's also great. Another thing is, you work with the EIB group, but also national promotional banks. Some of these banks do more than others, and some don't really cooperate with InvestEU. One of the reasons that's often cited is regulatory burdens, red tape, and so on. I talked to, for example, one big bank. They said we don't do it because it's just too burdensome. And then the Commission now proposed to also, let private financial institutions, work as implementing partners and take the EU guarantee or take EU financial instruments and implement them and take that de-risking into the market to then, go into projects that need investing in. But why should a private, financial institution want to work with InvestEU if some of the national promotional banks don't even want to because of red tape and so on? I think what needs to be done here, and maybe that's also coming a little bit back to what Cornel said before, is you need the right incentives. And maybe it would make sense to look into an incentive structure that where the risk, the profit risk calculation makes more sense for some of these private actors, for these private investors, to provide incentives to work with EU funding and then go and de-risk in the areas that are really needed. And so these are some thoughts on that.
Yes, of course, Sophie. And I would like to sort of circle back also to Maive. Okay. The point is not to put Maive on the spot, because everybody agrees that the Commission has done some bold steps forward. But let's have this discussion. Yes,
I can react on maybe two or 3 points. The last one, private banks. Just show me a bank investing in equity.
I mean, you could also, get funds involved there. And I think another important point is, of course, the scale.
I'm a little bit blunt, but what I mean is that private banks are not risk takers. And of course they are not, because they have clients and they have to preserve these clients, and they have also to be solid for the financial stability. So there is regulation making sure that they do not take risks. So it's one of the improvements for the next MFF is certainly not to open the implementation to private banks, because private banks will not be able to do so. And it is not an issue of red tape. It's really an issue of business model. Commercial banks can be part, of course, of the investment effort, but as financial intermediaries, co-investors, co-financiers, but not as implementing partners. And I do not develop on the fact that they have no public missions, in fact. So that's also an issue. But I would like also to maybe to add two very quick points. The first one, breakthrough innovation. Listening to what has been said so far, and more generally is being said nowadays in the Brussels bubble, I am a little bit surprised. The French for many years have been advocating for more industrial policy. Of course, it sounds great to me that now we are talking about industrial policy, but now we should also have a balanced approach. You cannot have an industrial policy which will be efficient if you don't have the prerequisite, and the prerequisite is to have trained labor force. It's to have people with affordable housing. It's to have resilient and efficient infrastructure. So at one point of time, it was taboo to talk about industrial policy, and now we are talking only about industrial policy. So it would be a caveat in this discussion. And the last point,
there is a question of sort of EU budget represents sort of a percentage or so of European GDP or EU GDP. National budget represents, was it 40, 50, 60%? So there's a question of what you want to do with that percentage.
No,
and you talk about affordable housing and I think so. I agree. We're talking about being strategic in making choices. I think
agree.
It's fair
there are different ways to do so, and I'm not saying that. And maybe a last point. Maybe you are right concerning leveraging. There are different ways to do so. And maybe also with blending. So if we can also discuss that later on if there are any questions.
Excellent. Maive, can we come back to you? But first I want to say that the question or the discussion is also open to the room. If there are questions in the room, please signal that. We have 20 minutes left of this panel, and I certainly wouldn't like to rob any of you of the opportunity to address directly questions to the panelists. But Maive, you've heard a lot of comments here concerning significant aspects of the architecture of the competitiveness fund. I sense, of course, an overall positive note, but also a lot of suggestions for improvement. And we've heard the question of clearer guidance. We have the question of certainly of more money. It's been halved since the previous iteration of InvestEU. There's a question of the willingness to build risk into the system, and there was also the question of burden in all this, what it actually requires to use this magnificent instrument to get investment outcomes. And I think the reduction of burden has been part of what has really been pushed forward as a streamlining exercise also of different instruments. But how do you react to this? And in this, is this unfair criticism, or is this all things that you are actively working on now in the co-decision process with Rasmus and others, and so that we have an even faster driving car when we come to the sort of the actual MFF?
Well, thank you. I do need to warn you that I leave in 11 minutes. But, well, let's come to the points that have been raised. I sense that the competitiveness fund is now seen a bit as a kind of a panacea that will now solve everything that has been problematic for I don't know how many years. So if we sit under an apple tree and we complain that we don't get pears, maybe that's not the fault of the apple tree. So the apple tree, and in this case, when we talk about the competitiveness fund, is a usual wording, plumbing structure. And a lot of the priority setting, of course, comes also from elsewhere. We have a whole political process whereby our Commission President is appointed based on certain political guidelines. We have mission letters given to commissioners. We have annual Commission work programs. We have a regulation, by the way, also for batteries, which is clearly there showing where Europe wants to go. So the regulatory side, setting the priorities, is there, and we shouldn't expect that all of it now suddenly comes from the competitiveness fund. The competitiveness fund is a way of making sure that we have indeed a structure whereby we can blend and combine funding, and that we nevertheless have also a way of certain political steer without telling exactly what projects should get money and what not. So the competition element needs to be kept for the projects that are getting funding there. So I want to point on a couple of, or maybe even three, potentially inconvenient points that were raised, particularly because I want to benefit from our parliament member being present here. So first, as to the strategic priorities, as I said, regulation and political priorities are a matter of political process, and then they will be reflected also in the ECF, but we should not expect the other way around, that ECF will start like suddenly creating all the priorities. However, of course, we have work programs which will give certain guidance to the way how the funds are used. But I would say certain guidance, because let's look at, for example, how our current EIB is working with certain guidance. They are dedicating 60% of funding to climate purposes. But it doesn't mean that we would start kind of directing EIB as saying, look, take this or take that. We give an overall guidance. And similarly, in case of national promotional institutions or banks implementing the ECF, we'll have certain guidance, but we are not going to go down there telling everybody very precisely what they need to do. They will have the regulatory side and political priorities coming indeed from the bigger machinery. And we still need to keep in mind that for the grants side, the horizon type of the work of the ECF, of course, there the Commission will need to set a bit more precisely what we want to get out of the money. And there you know that the current way how Horizon functions, with a way of collecting input, creating annual work programs, getting them all debated, and then finally calling for proposals. So something similar we will do under the ECF. So there will be both guidance and a competition element, but don't expect the ECF to solve it all. Now, second problematic, or I would say maybe a bit provocational also point is conditionality of public funding. And I very much liked what you said about China, because we are quite shy on putting conditions, and we are very big believers in neutrality. Technology neutrality, come with whatever, I don't want to use a bad word here, but come with whatever technology you think. We look at them, they're all equal. You can come with your flat earth. We will also very diligently assess whether your flat earth proposal is worthwhile considering. So we don't have, I think, a strong enough way of putting some things aside which no longer should be funded. And with the hat of efficiency, we have driven our implementing agencies to the level that they are no longer even able to go and check the projects. So if you look how Horizon currently is funded, and this I'm particularly saying to our Parliament friends, because they are pushing more money into Horizon and less money into ECF fund. So if we look at what currently is happening, we have pushed the administrative layer to be very, very slim, which means that in the name of efficiency, we don't put conditionality any longer. We don't go and check whether they have actually done something or achieved a milestone. This is not part of the way we currently do, and maybe we should. Maybe the inconvenient point is that maybe we should indeed put more conditionality to public funding and actually go out there and see that the milestones are achieved. So currently this, as I said, is not the Commission practice. Although we look at the end of the programs or projects whether they have achieved something and so on and so forth. So this we, of course, do. Now, another inconvenient point is about really planning what you call dirigism here, or this so-called invisible hand. We continue being very big believers in the invisible hand, and we are somehow surprised that the alignment doesn't happen by some magic. I think we need to invest more into the alignment. And we do get some help through these tools like IPSAs, where we would like to also use some of the ECF money to top up IPSAs, which are a way of coordination between European level and member states. So indeed I think more, at least coordination and alignment would be helpful. And now very finally on getting more money to the fund part, financial tools, why not? If the Parliament and Council agree, we will be, of course, from our side of the Commission, happy to receive. And I take seriously the point about making the implementation smooth and easier. This we need to really look into. It's quite complex, and it's the regulation, financial regulation and conditions that we have put there. It's to be checked if we can make it easier. Thank you.
Thank you, Maive, for some frank answers and also some inconvenient truths as you labeled them. Are there any questions in the room? Otherwise, yes, there are a couple of questions in the room. So we'll do a round of questions in the room. I know Rasmus wants to come in, and I'm sure also Cornel and Philip, for instance, would like to come in on the issues of conditionality and incentives. But please, yes.
Hi, this is Jacob from Euractiv. So I realize the focus on mobilizing investment, and which is why maybe the focus is so much on the Invest EU part. But I'm a bit surprised, like following what the council does quite closely. It seems like they're very focused on the governance structure of this fund, and that it's basically is very vague. And of course, for politicians, they want to know what they get. So, to me, it seems like the crux is whether you can do a very solid governance structure so they to do ambitious policy, and then maybe you can get countries to step back a bit. Or if you can't do that, they're just gonna keep carving up this fund into just piles of money for dedicated either geographical regions or specific industries. So I just want to say what's happening with the governance structure, and also on the political priorities. Of course, you're constrained by the political priorities, but one part of the governance structure is that you could, of course, leave more up to, as you say, to, for example, independent councils. And I think in Horizon specifically, it's the ERC, which is completely independent, which has delivered, is my impression, the really strong results. So, it seemed, I didn't understand, like, why is the political part a constraint when actually it seems like the programs that work the best are the ones where the politicians can step back a bit.
A couple of more questions. The question on the member state position is interesting. Maybe I'm a bit unfair now, but it sounds like what you're pointing to is that the member states are mostly focused on who's going to control this and not on the real outcomes, which would be sort of a classic Brussels fallacy. But I don't know if that's unfair. But anyhow, let's have two more questions here down the middle.
Thank you. Good afternoon. Servet Guren from the European Chemical Industry. I'm trying to stand up, but I have a laptop on my lap, so I will do it like this.
See you and hear you.
Okay, I will try.
It's okay, we can see you and hear you.
I could only give kudos to the Commission efforts to make the ECF, because I think there is definitely a need for an instrument where leveraging is indeed the focus. But my question would be the following. And this is what I a little bit missed in the panel discussions. When we speak to our members, because we talk about investments not being made in the EU because there is no business case, right? The Draghi report explained it all. Innovation ideas are coming from us, but the scaling up is happening outside. Now, when we speak to our members and to better understand what is hampering investments, a lot of topics pop up which not necessarily has to do with innovation, but for example, permitting, energy prices, etc. But if we take that out of the equation, and if we look at what would help them if all the prerequisites are met, energy prices are down, etc., what would help? Then a seed funding, so let's say the leveraging where public money is put in and private money is put out there as well, that will help out. That will help out projects that are now stuck in the pipeline, which are not getting a positive FID, a financial investment decision. So my question would be, where in the current ECF can we advise our members to go for their ideas of this? Because right now, such a platform is missing, and I was hoping to have that platform in the ECF, and we are very much looking forward for the coordination tool that we believe might be an answer to this question. But nevertheless, we would love to hear your input on this. Thank you.
And so where can companies turn to really get that seed money? There was a STEP platform, but we'll hear about. And then the final question. Yes. Well, we have two ones then. Yep. First, quickly, present yourself and
Good afternoon, and thank you for this insightful panel. I'm Mene Berardinelli from the oil and gas industry, and I can relate a little bit to what has been said during the previous question. But in the sense that InvestEU heavy loan type guarantees can obviously de-risk a lot and cover the cost of fund more easily the cost of risk than the cost of funding. And this is true for innovations, this is true for operating assets, but it's not entirely the response for, or not always, for CapEx heavy investments. And for the same, that's why I relate. Where can I look for this kind of relief or support inside this ECF, and what is being thought in terms of blended funding or blended de-risking measures? Thank you.
Excellent. And the final question, yep, here in the middle.
Thank you. Lasse Bohm, European Parliament. I'll be very quick. I just want to come back to the governance question, because there's two different things, right? The first question is the money. The second question, who decides how and what to invest into? So just a quick question to the panel. Would you then say or think that we have too many tools and instruments and platforms to decide where what qualifies as strategic investment, i.e. would, in an ideal state, we're starting with a clean sheet of paper, would we need to scrap those existing instruments like Repower and the European semester and the CSRs and now the MFF funds, and just have something new? Thank you so much.
Excellent. We have 3 last 4 questions, 2 on the governance.
Sorry for the ultimatum, otherwise you will not have me responding. But there are really very good questions you're putting forward, which allow me for some more inconvenient points to be raised. And it would be a pity to leave them out. So first on the governance. I think it depends also on the implementation channel we're looking at. When we talk about EIB or national promotional institutions, they have their governance. And believe me, member states, each of them have a seat in the EIB board. So voila, they are there. Now, if we talk about the other types of grant type of management, then currently we can look how it happens in other programs. Again, Horizon is a good example. Member states send their ministry representatives and experts to the committees looking at annual work programs. So we have to keep in mind what they decide. They don't decide on individual project. They decide on the annual kind of work program based on what the calls will be then done. So they should not be dreaming in the council that they are going to be individually choosing what projects will be funded from the ECF. This is not what we are having in mind. The involvement would be rather really at the kind of a more strategy and programming level. And the idea, of course, is that stakeholders as well as member states will have a say. So that's clear. But this is also already in the Commission proposal. It's just a question of maybe not being clear enough how it all functions. Then still on the governance, of course, the businesses can and should have the say. Also today you have something called Industry Forum, whereby you can give input to the Commission, particularly to DG GROW, but we also work with our colleagues in other departments. And similarly, in the future, the stakeholders' voice should be indeed also channeled to the priority making. So that's one, the governance point. The other point I wanted to actually comment upon is why the European Research Council works. I think it's a very good point to make. But I think it works because they have experts who are looking at what should be in the annual work program. And we, by all means, want also experts to try and design the annual work program for ECF. And then the other tricks that makes it work is that there is a very clear responsibility in the project itself. And this is not always the case currently when we talk about collaborative research-led or collaborative projects under Horizon second pillar, where we have the industry-driven research. There we have often a bit diluted responsibility. Too many participants, not clear who finally will be the owner of all these new ideas and so on. So we may need to look at really the design of the projects as well to make sure that we have very clear responsibility and incentives built in to deliver on the results. And I will be very much in favor of some conditionality as well, but I may be a consenting voice there. And then the business case, of course, depends also on what do we want to scale. And that, I think, is a problem that we are often taking examples from the US where they are scaling more rapidly, but they are scaling often things that are easier to scale, like digital platforms or financial intermediaries. Here in Europe, we are trying to use the same tools and scale industrial endeavors. And then we fail because the working capital is not there. Our state aid, by the way, our competition law is just strangling us. So if you want a door to knock at, DG competition might be a good door. Because really, to get the manufacturing industry scaling in Europe, we need to be seriously looking what currently is hindering. And maybe the way of not providing some breathing space for them is a point we need to be looking at. Voilà, I think that's the main things I wanted to say. And geographical balance, I believe, will be improved in the ECF compared to what we have currently on the horizon, where majority of funding goes to a small number of well-established member states. I think under the ECF, we have tools and ways to get more also to the periphery and to have new endeavors taking up in smaller member states as well. So I'm actually very positive on this side for the ECF if I manage to get it through.
Excellent. We have more time in the second panel to talk about scaling and market dynamics. So let's not necessarily get too much into that now, but I would like to give the other panelists also an opportunity. Thank you so much. An opportunity to respond to the questions they feel they want to respond to, but also to make some final comments. And I think Maive twice now actually sort of made a hint about conditionality and how to build, whether there should be more conditionality in the system, what kind of incentives one is building into this construct. So let's do the reverse order now, starting with you, Philip. What sort of your final comments, or there was also a mention of the IPSAs. I mean, this is something you work quite a lot on. What is for you is the critical thing now that needs to be put right?
Indeed, I think IPSAs is an important point because we have 50% of GDP spent by member states. And I think that also alludes to what Maive just said about a state aid. And I think to leverage that instrument better, to make it more lean, to make it easier to access, but also have some EU funding in there, and that's also in the proposal that can give it some sort of central EU added steer. I think that's very important. Then when it comes to where you can turn to, I think in some ways InvestEU is there, the STEP initiative. Then there's this new seal that's been proposed that can make companies more visible for funding. I think there's some progress, but I think also it has to be all in one database. I think there's also there are ways to do that, and there's the intention to do so. I think when it comes to governance, I think Lasse was referring to all the different mechanisms that we have. Of course, there's this competitiveness coordination tool that is proposed. We have argued sort of against that, to merge it rather with existing instruments or merge them all together, not to have another one. I think it's important to be lean there. So I think you're right. We need something that it doesn't necessarily have to be new, but that has to use the synergies better.
Avoid too much complexity. Sophie, over to you. There was a sort of question about blending instruments, going from 1 to giga, big manufacturing projects.
Right.
Is that something you provide, or does one have to look at the European level for that, or how?
No, we can provide that, and I think more generally it's linked to conditionality, as I understand it. If the Commission or more generally the political authorities wants to steer precisely the investment, blending is a very useful instrument because they can define precisely what they want. then they will deliver the grant according to these criteria, but with blending, that is to say with the financial instrument coming on top of that and making a leverage effect on the grant component. So you have both advantages. Both you have the steering, political steering, the conditionality, very clear, and you have the leverage effect. So yes, indeed, with blending, you can do everything. You can finance big capex projects, but you can also finance very small territorial projects. It's really flexible, and you have to go to the institutions, financial institutions that are able to deliver this type of financing. And in the next MFF, we need more blending.
Excellent. Now, Cornel, we sort of this final round moved into question about conditionality, incentives. I guess China's sub-funds or their financing system are really providing radical incentives sometimes. Is this something you read across from China here again to Europe, or is there other final comment you want to make before we go to Rasmus, who as a politician gets the final word?
System is tight. Just two comments. The first one is that a lot of the conditionalities are administered through third parties, usually in exchange for a fee. The private is privately operated. So I'll give you an example. People's Bank of China, a green finance instrument that refinances 60% of the principal extended to clean tech firms. Gets half the policy rate, but then they have to do quarterly reporting on emission reductions in their operations, and the reporting is not done by the bureaucratic bodies, it's done by private consultancies. And because the scale is so big, you're looking at, as of last year, 4 trillion euros in green credit over the last 10 years. There is a lot of business, so these guys can operate on very large volumes, low margins, and their fees are low. So it actually, for something that is a party state, they actually have a very private way of extracting that service. The second comment, the sub-funds in which the public funds or funds invest are by mandate technology specific, right? And they have to demonstrate in the design of that mandate that there is a local, most of them are provincial and municipal, that there are actual capabilities in that area, technologically, in terms of industrial base, that they can scale up companies there. But they're not allowed to move into, I don't know, shopping malls or innovating, I don't know, some kind of new app. If they're in deep tech, hard tech, they have to stay there. And the kind of engineering, their management blends engineers and financiers. Therefore, they have more risk appetite for technological risk because the engineers understand technological risk better than the financiers. So there is a sort of sociology of management elite there that is different from how ours operate.
So essentially the risk taking and then the outcomes is also dependent on who you have managing these instruments. But we'll get to there. We have a panel coming up at 4 o'clock on the market potential, on the market instruments, and I'm sure we'll talk more about also looking at more technologically specific instruments in that context. But Rasmus, we need to wrap up, but we don't want to wrap up without sort of hearing the final word from the European Parliament. How in the light of this discussion or your overall analysis of this, how do you where do you want to take this forward now? Do you think that this is a proposal now that can be made to achieve even more things? That's what's sort of currently built into the plumbing, as we were using those terms.
Well, as I started saying, I think indeed we have something to work on. But again, I mean, I think the way the Commission a bit reacting to some of the critique I found a bit strange or questionable, because of course nobody is counting on this on the competitive fund to solve issues that should be solved everywhere else. But we're counting on the instruments we're putting into the MFF to be able to work with the political system, with the strategic choices we are making. And I'm sorry, we had a commissioner president who was approved after the election in 24 on a clear mandate. It's not reflected in the competitiveness fund.
What's that? Is that not enough green finance?
There's not. No, but I'm sorry. To continue a green transition and talking about the decarbonization of European industry and then putting 26.2 billion to this area. I'm sorry, that is ridiculous. It's ridiculous to talk about we need innovation, we need new answers, and then have an Invest EU, which is the great fund to go in and work on some of these things with the size it is. So we are not answering with this MFF. The Commission, I think, has taken some steps, and now I hope, from a green perspective, to be able to help them to actually fulfill the ambitions. Because the
money going to instead, just to understand.
But the money, but the money is going to is basically we have the same size MFF as we had before. Of course, a lot of going to core issues, cohesion to agriculture, and then we have a large sum going to other areas where we say we also have defence, we also have the digital. But if we have an overall Commissioner President being approved on a green mandate saying we want to decarbonize, it has to go into all the areas. And that's where you have your political mandate. That was not fulfilled. And I think that is the problematic part as well. We also had the promise in the hearings of a fossil-free MFF. Where is that reflected in the competitiveness fund, that it's actually a fossil-free competitiveness fund? So the political ambitions, the road we took politically after the election, with a new parliament, with the governments being as they are in the council, is not really reflected here. And that's where we need to help them. It's good steps. I mean, I haven't been overly criticizing what I see because I see good ideas in this architecture, but we still have steps to make if we really want this to be a strategic investment budget. And that is what the MFF is. It's not a budget like the national budget. It's something else, and that could be reflected a bit better.
Excellent, Rasmus. You got the final word. I think we've had a rich discussion ranging from the availability of money in this, but not only the question of bigger numbers, the question of sharper choices, political choices, guidance, the question of how you mobilize leverage, and also the question of accountability in all this. So please join me in thanking the panelists. I think they've done a very good job. Don't leave us. We now have a coffee break of roughly 20 minutes, so everybody can get a cup of coffee. And then we return at 4 o'clock for panel 2 today, which is on the topic From Savings to Scale-Ups, Unlocking Europe's Market Potential for Strategic Investment, also with an excellent group of panelists. So stay put and have your coffee, and thank you very much to the panelists.
Hello, everybody, and hello again to those who have already attended the first panel. My name is Philipp Lausberg. I'm a senior policy analyst here at the EPC, and I'm going to moderate this second panel, which, after we've talked about the MFF, public EU financing, will now turn to markets. So the title is From Savings to Scale-Ups, Unlocking Europe's Market Potential for Strategic Investments. So how can we mobilize markets, stir those animal spirits for strategic investments and go ahead. I would like to briefly give you some opening remarks, then I will introduce the panelists, and then we'll have a hopefully very interesting and open debate. So we've seen that public spending is important to tackle the epochal changes we're going through in technology and geopolitics and so on, and especially to fix market failures, and to make private money go where they're too risk averse to go, but it needs to be spent to crowd in private investment, and indeed for tackling the kind of challenges that we're facing in security, in sustainability, in competitiveness, and in technology and so on, we, of course, need the private sector to do the heavy lifting. And that means financial markets and banks, but also individual investors and companies need to invest, of course. And one that can come from inside the EU, but also outside. So international investment, of course, also needs to be attracted. The EU has 33 trillion in savings. It has one of the highest savings rates in the world, actually. And it has very large institutional investors, as particular insurance companies. They hold about 3.6 billion in assets. Also pension funds, a bit less big, because we have a lot of pay-as-you-go pension systems that then invest less. But 300 billion of these savings go to the United States every year. So clearly, the conditions for investing are not as attractive in Europe as they could be. Of course, U.S. financial markets are particularly deep and integrated. Americans tend to be more risk averse than Europeans, and so on. So there are a lot of arguments one can bring. Also, the European financial system is much more bank based, so capital markets are just less of a thing here. But of course, markets are fragmented. It's much harder than for larger funds to emerge that can deliver the big ticket, long-term, and risk financing. And these are the three key, I think, dimensions here that we need to face the challenges of our time, basically. So that's scaling up mainly breakthrough technology, but also infrastructure, mining, and so on. Europe has great research facilities, they have great startups, a lot of innovative ideas and all of that, but at some point they're hitting a ceiling when it comes to financing from Europe, and that's a so-called scale-up gap, when a lot of them either go bust or they go to the United States or elsewhere. How can we fix this problem? I think that is very much the question of this panel, because the EU is losing enormous potential here. And if you look at, 14 public companies were valued at 10 billion or more in the past 50 years in the EU. In the US, that number has been 241. So how can we make sure that markets do their job, so to say, and really channel that money, institutional investments, savings, and so on, to where it's needed most? And that includes, and I think that's going to be the focus of this discussion, tech scale-ups and other strategic sectors. And how can we do that quickly as well? Because, of course, the changes that we're going through are unprecedented in their speed when it comes to technological development, but also when it comes to geopolitical change. And the time for that really is therefore now. And we have, of course, a situation that is sometimes bleak. There's a lot of challenges, but this situation also holds a great opportunity. And looking at the volatility of U.S. economic policy, the decline of rules-based institutions internationally, and in the US, of course, and the rapid erosion of the so-called Washington consensus, that heralds profound shifts in international capital allocations and markets. And if Europe can adopt the right reforms, if it positions itself well, then the EU could be well positioned to actually reap the dividends of its model that is based on predictability, that's based on an open trading system, on a stable global euro, on a supply also of strong, high-quality investment opportunities. And with that, I would like to introduce this very distinguished panel to you. To my immediate right, we have Victor Engelsson, who is a partner and head of early stage technology at EQT, a European private equity fund, in fact, the second biggest in the world, but he'll talk about that later. Then to his right, we have Merete Clausen, who is the deputy chief executive of the European Investment Fund. To her right, we have Carrie Evans, who is managing director of global public policy of the Global Public Policy Group of BlackRock, a big American international investor. And to his right, we have Laura Panella, who's a member of the cabinet of Commissioner Albuquerque, so very much working on the Savings and Investment Union. And finally, last but not least, our very own Georg Riklis from the EPC, who is Associate Director, and also the co-author with me of the report on strategic investments that you can see over there, where we try to find, or where we table quite a few recommendations how to solve the problems that I've just alluded to. I would like to now start by posing the first question to Victor. So, as I said, you're head of early stage technology at EQT. It's a very successful private equity fund. It's European. It's from Sweden. Okay, Sweden, of course, is known as having, when it comes to financial market, to having a few things speaking for themselves. But how would you say what would have to happen in the EU? What kind of things would you like to see from policymakers that would enable European private financial institutions like you, and also maybe smaller actors that are not as successful yet, to provide more scale-up financing in the EU? What needs to happen that we can, bridge that scale-up gap and make companies stay in Europe, and not lose so much potential to the US?
Super. Thanks for the question, for inviting me, and also for the introduction. I think you did a good job in introducing EQT, but maybe just elaborating 30 seconds of who we are. I told you earlier today that we're one of the best kept secrets coming out of Europe. We are actually a top 3 global private investment manager, and have scaled in Europe, gone global, and have IPO'd in Europe. So we have done what we want many of the companies we invest in here in Europe that they should do themselves as well. So showing it can be done. And coming out of Europe, we're of course deeply committed to Europe, and we stand and fall with Europe's success. So we have invested 120 billion euros over the last 5 years in Europe, and we look to double that to 250 billion over the next 5 years. So we have a very positive view at the moment, and I think we actually see it as an opportunity of a lifetime for Europe, because at least I spend the majority of my time investing in the earlier stages on the venture and growth in the scale-up phases, where it's all about talent. So when it comes to talent, the opportunity of a lifetime is really to stop exporting all the talent that we produce in Europe to US and start becoming net importers of talent instead. So I guess the good news is, and you alluded to it, is that we're doing all the hard work already. We graduating all the engineers. We have more software developers than in the US. We publish more scientific research papers, etc. So that is great. But now we just need to make sure that these talent and these companies can stay in Europe and be successful and scale. And I think we applaud and very much welcome some of the initiatives that are in the making in terms of the 28th regime. I think that's exactly what needs to happen. We firmly believe it needs to be a regulation and not a directive for it to really have an impact. It's almost then don't bother if you might only create even more confusion if you can't produce predictability with it. I think on the savings, you mentioned it as well. I think there's of course a capital component to it, but when we speak to companies and founders building in Europe, it's basically 3 things that they need to become successful. And I mentioned talent already. That's the first element. And then it's customers, and then it's capital. And it's in that order, and it's really sequential in a way, but it's also reinforcing and amplifying in its nature. So if you double click on the talent side, we have recently invested in a company called Lovable, which is actually the fastest growing company ever coming out of Sweden, Europe, which we all should be very proud of. And they are now at the phase where they are attracting talent from the Bay Area. So people are relocating from the US to Stockholm with their families to be part of building this company. So that's part of like reversing this trend, which is fantastic. But when my view is that there's still some structural challenges in terms of being able to offer options and allowing the employees in that company to participate in the value creation journey of that company. And on that point, we're not competitive in Europe, in many countries, and also in Sweden. So if that's not fixed, then unfortunately, I think that company will eventually be forced to move to the US. So that's just the criticality of it, and I'll speed up.
And
Sorry,
what would you propose to do to prevent that from happening? I mean, this is a peculiar case, of course, but more in general, what is it more the sort of the regulatory aspect? And I would like to maybe concentrate a bit more on the capital aspect of things.
Yes,
but which, of course, for you personally, for you as an institution, is the least problem, I guess. But yeah.
No, but I think on that problem specifically, I would say it's the 28th regime is part of the solution as long as you can get ESOPs into it, because that will create a new cohort of companies, and then hopefully with that there will be an understanding, even depending on how the taxation of those ends up. But still, I think it will provide a foundation for a more competitive and predictable setup in Europe as well that can be competitive with the US.
So basically a selective regulatory system for a particular kind of company, mainly competitive startups and so on, that can then move at a quicker pace than everyone else. Yeah. So that's to make life for them easier. That's sort of the 28th regime idea, of course, and that I guess that's very much the regulatory aspect. If I may now turn to Merete Clausen from the EIF. Of course, the EIF is funding VC funds. It's investing in venture capital, in scale-ups. It has also founded the Tech Champions Initiative, or it's managing it. So it's very much in the business of trying to make startups grow and scale up in Europe, and helping also to fix that scale-up gap. On the other hand, what one hears often is that the investments that are made by the EIF in venture capital funds are usually not necessarily invested in the more breakthrough ideas and the riskier long-term investments. And so it clearly has the ambition to set market signals and create a market for later stage capital and so on, but it seems so far it didn't succeed to the extent yet that we really would need to see. So what can you say about how this can be fixed with what you have now, and what you will do going forward to play an even bigger role in de-risking and really getting us to fix that scale-up gap?
Yeah, thanks a lot, Philip. And the EIF and the EIB have already been mentioned so many times during the earlier panel that I feel my ears were ringing. But still, just for those who may not know us that well, the EIF, the European Investment Fund, is part of the EIB group. So we are a subsidiary of the EIB, the EU, and a number of mainly member states promotional banks, actually, like the CDC and others. And we are, within the EIB group, we are focusing on risk capital, on venture capital financing, but also on issuing guarantees for financial institutions in the member states that can then use them to on-lend to SMEs. And if I should really put emphasis on what it is that is the philosophy behind what we are doing, it is to build up ecosystems in Europe. Ecosystems, both in terms of, as I was saying, this network of banks in the member states that can support innovative SMEs, other types of businesses also, and also in terms of building up the funds like EQT is a rarity in Europe. We don't have as many big funds in Europe as we should have. Compared to the US, it's what we call mega funds, so the funds that can reach a target size of around 1 billion. We had prior to 2022-23, we had about 10. And they had at least 10 times that in the US. So this was something that we had diagnosed already pre-Draghi, if you will, that there is a lack of big funds in Europe that can ride out the big tickets that the companies that are looking to scale in a number of sectors, but in particular in tech and deep tech, those big tickets, simply the funds that have the size to do so, to write a ticket of 100 million, for instance, in a scale-up company, there are simply not enough of them. So what we did together with a number of member states, it started as mainly a cooperation with France and Germany, but then was added also Spain, Italy, Belgium, and the Netherlands, was to pool money from those member states with the purpose of using them to invest into funds that are already very sizable, but to give them the possibility to reach that mega fund level that would allow them exactly to invest into those type of companies that really need a lot of financing and need to find it here in Europe and not necessarily have to go to the States to find them. So this was, we set it up in 2023, which means that now it has run a bit more than 2 years. We have supported 12 mega funds, one of EQT's fund as well in the healthcare growth segment. And these funds are now, which are very big funds, so it's a type of a fund-of-fund setup, a bit similar to what we heard described this earlier today from China. These funds are now starting to invest into companies, and already a number of these are unicorns. So unicorns are companies that have a valuation of at least 1 billion euros. So this is already having its effects in the markets. We are seeing all these delicious companies coming up and being invested by our funds. So with that, and we have been very much a part of creating an ecosystem for early stage VC, and we're very proud of that. In the 30 years we have existed, but we are now trying to achieve a step change, both in terms of the size and the scale of the funds we can support, but also a step change in terms of the critical technologies that we need to have developed here in the EU. And this we do under an umbrella that we have for the whole of the EIB group, which is called Tech EU. And with that, we intend in the 3 years until the next EU budget comes online in 2028 to have channeled some 70 billion euros into deep tech and tech in all areas such as digital, AI, quantum, health, such as EQT, but also energy, you name it, defense as well. And for the EIF, we will out of these 70 million, we will target at least 70 billion. We will target at least 20 billion of that. And we are actually very well advanced. Last year, we achieved more or less a third of that. So this is, I think, addressing some of the things that you were saying also in your report, that not enough money is being put out there. And of course, when you look at the needs that Draghi also brought forward, everything looks small, but 20 billion is over 3 years is significant. And then comes what next? Because we are intending now to enter into a second phase of our European Tech Champions initiative to bring in more member states, because a lot of member states have told us, look, it's very good to target funds that are over 1 billion, but we don't have those in our ecosystems. So we will look also at having a window under ETCI that will target funds from, let's say, 300 million and upwards in size. And this has been very well received already as an idea from the member states. And then we will want to bring in also the private investors to do, in a sense, what TB, the TB initiative in France and the WIN initiative in Germany are doing, but at the European level. In order to also support the objectives of the Savings and Investment Union.
So yeah, thanks very much. I think it's really now about how to get more countries, also private investors into the Tech Champions initiative? How do you also attract, for example, institutional investors? I don't know if that's something that where you have a plan or a clear way how to attract them. What is also worth mentioning, I think, is the idea of Scale Up for Europe fund that is currently drawn up by the EIC, and that works on a logic of working very much with pension funds, with institutional investors, professional investors, having also private investors leading it, and very much also with the goal of having long-term stakes and more risk-taking. So you're talking about ecosystem creation, about that's very much the role of the EIF. If I now turn to Kerry Evans, so you are representing BlackRock. How do you think the ecosystem in Europe is? How attractive is it for you, but also for other international investors to invest in Europe? So in our report we write, and in 2023 we had net outflows of capital in Europe. This has changed somewhat now, also thanks to Donald Trump, I suppose. But what is it that is still keeping investors away from Europe, and what do you want to see? If what's the thing you think is the most important thing that needs to change for more international investors to invest in Europe and invest in strategic fields, invest in scale-ups and so on?
Thanks, Phil. That's a really good tee up to this question. I think I'd start by just sort of a little bit of a level set on an asset manager like BlackRock versus a sort of large institutional investor that's taking views with either proprietary capital or capital they've raised for really specific purposes. So we're obviously a large, very diversified asset manager that operates globally, but we operate incredibly locally at the same time. At the end of the day, we're facilitating asset allocation decisions of our many clients around the world, be it individual retail savers, many here in Europe or around the rest of the world, or institutional investors like you mentioned, insurance companies or pension funds. But at the end of the day, it's really their views that matter. It's how they allocate capital in the broad sense. Asset managers like BlackRock are there to provide expertise, and obviously the global scale and local depth with which we operate in a lot of markets gives us, I think, interesting insight to help sort of steer those capital, not steer the capital flows, but steer some of those decisions, guide some of the decisions, and certainly execute them. I'm going to take a slight step back on the question specifically of scale up, because I think it's really difficult, I think, to isolate specific segments of the capital markets and look at them in complete isolation from the rest of capital markets. And second, I think if you were to dive down into sort of some of the structural issues that we can talk about a little bit more in the sort of specific startup stage, there's a lot that are really common to growth areas for capital markets more broadly in Europe. But in my perspective here, small plug before I get into this, I wrote a white paper recently with some of our colleagues, available online. I do have one printed copy here, but really looking at the growth of European capital markets through a policy lens. And I say policy really deliberately rather than regulatory, because I think so much of what drives sort of depth, capacity, and dynamism in capital markets goes beyond sort of the regulatory framework for financial intermediation. It touches on culture, risk appetite, and broader economic policy. So that's my broader framing of how I'm going to approach this question of capital markets. I look at this question through the lens of supply and demand. Right? Every capital market is a market like anything else. It's driven by supply and demand. In this case, it's a supply of capital and a demand for it. So very often in policy conversations, I find that we look at capital, we talk about investment through a sort of one-dimensional lens. We look at the capital component, right? And that's an input to the economic function of investment. The other component to that is someone taking economic risk with capital as a tool in order to grow their business, adapt their business, whatever it's going to be. That sort of economic risk-taking function is incredibly important in capital markets. If you have one-sided growth of capital markets, i.e. more capital in and no commensurate demand impulse, you're not actually solving an economic problem per se. There are some interesting questions about sort of participation, which I think are somewhat separate to the conversation we're having, that are really good conversations to have, but I'll leave them aside now. So as I take a step back, what separates sort of European capital markets as they look today, from the potential of what we think European capital markets can and should look like. If you look at sort of some of the framing of how I know the Commission is looking at the potential for capital markets, or how they're framed in the Draghi report, really as drivers of economic transformation that needs to happen, drivers of filling this investment gap, what are some of the sort of structural features on those supply and demand sides that I think need to change from what they are today? Well, one, on the supply side, it's probably not rocket science, but there's a really big gap, I think, for household investment as compared to a big market like the US. You can see that either in sort of breadth of participation, where more households participate in capital markets in the US. It's about 60%, in Europe, 35, give or take. Or you could look at it from the inverse, which is take a segment like equity markets. So in the US, about 40% of US equity markets are made up of US households. In Europe, it's like 10%. That's a really big difference. And when we're talking about sort of depth of market and ability of big segments of our capital markets to play the functions that they need to play, and they're not disentangled from the specific question of startups and scale-ups. I think they're all part of a really highly interconnected ecosystem, which we can get to as we go on a little bit. The other bit that I think is really important, you talked, Philip, a little bit about insurance. The insurance industry is a really important way in which sort of household savings certainly are intermediated in Europe, and they're a really important institutional investor base across a lot of asset classes. But one area I think that really strikes me as an outlier from a lot of other big developed capital markets is funded pensions. So across the EU, we have some exceptional funded pension systems in specific countries in Europe. But if we were to take sort of the European average, pension assets are about 20% of GDP. So contrast that to the US, where US, Canada, and Australia, all very big, well over 120% of GDP. There's a big difference there. And so when you're talking about investment horizon, risk tolerance, and sort of like depth of ability to be anchor funders and some of the things that you're talking about, which is growing scale in the individual ways in which that type of capital is deployed, I mean, that's a really big glaring deficiency from my perspective in terms of how European capital markets look today versus what I think they need to look like to fulfill some of this vision of intermediating capital in specific ways. So I talked about this in supply and demand, and I think the demand lens is also really important, and it's one that we don't talk about a lot. There's not a lot of sort of magic solutions to it. It's a really complex question to disentangle. But I said that markets need a demand impulse as well, and that ultimately what we're looking to solve for, which is the investment question, is really about people putting capital to use. Well, that's the demand impulse to me. That's where capital as a tool meets the real economy and is directed for the specific purposes of innovation, growth, hiring, whatever it's going to be. One of the things that was really interesting to me as I wrote this paper with colleagues was we often have this headline assumption that the way that sort of savings and consumption of capital works is that households save and companies use that capital. It's a lot more nuanced than that. And if you look in aggregate, right, look at sort of like financial account balances on economy-wide levels, all of these things have to balance out. You can't have consumption of capital without surplus of capital. And within a specific capital, if those don't, or within a certain economy, if those don't balance out, you then have outflows of capital to other places. You were talking about the 300 billion that we talk about. I mean, to me, I haven't seen that stat it gets talked about a lot in Brussels, the 300 billion of capital outflows every year from Europe to the US. I haven't actually seen the specific stat written down and completely substantiated, but part of me sort of suspects that there's quite a straightforward explanation there on that supply and demand lens, and that Europe is very clearly in capital surplus and has been for a long time. Europe as our economy is a net saver, and our economy is not doing the job that it needs to absorb that excess savings in the rate that it needs to happen. So I said this assumption that we have of households save and companies consume is not exactly the case. If you look across the big European economies over the last 15 to even longer in some of the big European economy, non-financial corporates have been net savers for a long time. So that picture of sort of like, where is this innovation, where's this investment happening? If you believe that the investment that we are trying to drive is corporate or capital investment at the economic level, that's not happening in the aggregate level in European economies to the level that it needs to, even to absorb the household savings that we have today. So we can have a really interesting conversation about how markets function and how they're intermediated. And I think that there's a lot to dive into in the sort of scale-up phase, whether we're talking about are equity markets fit for purpose for off-ramps. To me, off the top of my head, there's a lot of ways in which European equity markets could be deeper, more liquid, better connected. The European Commission is entirely on the case, as far as I know. But I think there's a deeper structural question. There's a lot of improvements that can and should be made in capital markets, and I think capital markets will play more of a role moving forward. I'm actually quite optimistic, certainly about some of these changes on the demand side. I'm not one of the pessimists that thinks, woe is us, we're really falling super far behind. I think there's a lot of progress actually happening on the supply side of capital markets in Europe. A lot of it is generational. A lot of it is technological. I don't think it's entirely a regulatory story today, but I do think that there have been regulatory changes that are in the process or that are also being put on the table. So I know the pensions package is something that I'm really interested in, as you can probably tell from sort of how I outlined some of those remarks. And I do think that that'll be a tailwind over the next 5 to 10 years as well in terms of like how we think about the growth of investable capital being intermediated through European markets. And I have no doubt that if the economy can provide that need for capital, that there's no reason to me why I would think that there's some sort of inbuilt bias of the system to intermediate it elsewhere, if that makes sense.
Thanks very, very much. Very interesting. So you're not, because when you're in Brussels, often you hear two things, red tape and lack of integration of capital markets, and that makes everything super difficult. And I didn't hear that from you. I mean, you alluded to it very briefly, but it doesn't seem to be, in your eyes, the main problem. I can see the structural dimension of it, the savings that come with export surpluses and all of that. But also, I think, interesting to see companies don't seem to invest enough, and I think that is something that might have to do with risk aversity, with things that, but that these are things on the demand side, right? And I guess these link up to labor market conditions. They link up to all sorts of conditions that companies would like to have to expand, to invest, and so on. So that leads us away a little bit from the discussion on supply, on capital supply and intermediation, of course. But I think it's very important to mention. You said that, insurance and pension funds, that is really the frontier where we can do more to invest more, and that a pensions package, for example, that could really make a difference, if I understand you right. If you have, on the other hand, of course, also member states to move away from pay as you go and have more sort of investment pensions. And so talking about these 2 points, I would like to now turn to Laura Panella, who, of course, at FISMA, or at least at the cabinet of the Commissioner Albuquerque, is working on the Savings and Investment Union. So what is the plan, or what's the progress you see in really getting that institutional investor money into the strategic challenges that Europe faces, like scale-ups and so on, and what can we do about it? What's being done? Is that enough? I mean, we see, there's a bit of fine-tuning on solvency, prudential incentives for equity and long-term assets, reducing capital charges, and so on. I mean, there's a lot going on right now. But is that enough? What do you think? And what's the timeline? What's going to come next? And is this? What's the plans? And does the Commission have what it takes to make a real difference there?
Thank you very much, and good afternoon. To reply to this question, I need a couple of hours. So if you be patient, we can do it. So we have spent the entire 2025 in revisiting so many different legislative proposals that at the moment no one of them has been approved, because we are still in the Parliament and in the Council. So the question how long this will take, it's not completely in our hands, because we have to wait the two co-legislators decide what to do. Just to give you an example, we adopted in the Commission. We adopted in the Commission the securitization package in June, and the Council adopted the general agreement in December, and the Parliament will adopt its opinion in May. Then we will start the negotiations, the trilogue, and so on. So it's the timing, we hope, could be accelerated, but is not completely in our hands. How we see the issues? The issue is around the management of risk. So this is the key question. How this continent is able to manage risk. Because if we would like to have zero risk, it's obvious that we cannot finance innovation with private money. Then this will be completely in the hands of public money. To the extent member states, MFF can do it. If we start inserting a certain grade of risk in the process, then we can extend our capacity in financing innovation. Because innovation is per se a risk activity. To do this, what we need? From one side, it's clear that we have to preserve the financial stability, because the price we pay in 2011 and 2012 was enormous on this side, and then is something that we have to preserve. But on the other side, what we can do is to see legislation by legislation, and this is what we are doing, how we can introduce the possibility of better management of risk. This is what we have done in the securitization package. This is solvency for insurance. This is our recommendation for pension funds, and so on. In December, we adopted, then we will see, a big package revisiting 17 different piece of legislation, without mentioning what we are doing with the level 2 of regulation. That means implementation act and so on. So from one side, we are trying to introduce to the capacity we can have in mind the financial stability, the possibility of delivering more liquidity to the market, to better manage a certain level of risk, and so on. But on the other side, there is a problem of scale. Because the smaller operator we have, the less capacity of managing risks they have. So if the market remains fragmented, we are condemned in having small operators. And you cannot ask a small operator to have a huge risk capacity, because they have certain limits in doing this. If they look at the panorama of our pension funds or insurer, maybe it's a situation in which we have a better scenario, you see small operators. These small operators are investing in national government bonds and real estate. Because if they invest in a risky fund and the situation will not go well, for them it is a fundamental risk. So we have two angles of work. One is revising the legislation to allow the operators to be bigger and to take more risk. On the other side, to work with member states, because a lot of competence remain in member states, as for example for pensions, to start understanding the way of how the fragmentation of the market is impeding this continent to have big-scale operators. Because a big scale is not valid only for companies, also valid for financial operators. The bigger they are, the bigger is the capacity to have a big market, a deep market, to operate in different countries and a different stock market and so on. And this exchange could be done at the EU level, the more they can manage the risk and the more they can finance innovation. Otherwise, we are in a scenario where you have so many different operators investing in safe assets, or supposed to be more safe assets. This is one of the reasons why we have this housing problem, for example. Everything is linked, like you said. So there is no single partition of the market and you look and you solve one single problem. In certain cities, we have a housing problem because institutional investors are investing in mortgage, in real estate. To what extent we can convince institutional investors? Legislative aspects. We have also adopted this legislative program initiative. That is the possibility for institutional investors, EIB, EIF for examples, but also the national promotional banks. When they have a project, they are investing, they can attract banks and other investors. And in this specific case, the capital ratio will be reduced. So this is what we are doing. We are trying to reduce the capital ratio for banks, for insurers. We are trying to increase the size of pensions for two reasons. The one that I explained, size count and rules also counts for management of risk without undermining financial stability. The last point is this enough? I don't know. It's the good direction. Why? Because we need to work also on financial literacy. We have to work with member states on taxation. We have to work on with member states on avoiding gold plating, on avoiding these national rules that de facto undermine the capital markets at EU level. This is not completely in the hands of the Commission, as you can easily understand. We have the European semester process in which we convey message and
thank you.
Request to member states. Then we will see.
Thank you very much. I think you outlined quite clearly what the problem is when it comes to financial markets in Europe. So it's about taking more risk, but it's also about scale. And the two, of course, are linked as well. Yeah, when it comes to taking more risk, it seems to me that it's easier to get reforms over the line. So you talked about solvency, about prudential rules and things like that, and there we see change. But when it comes to integrating the financial markets, that's the real hard nut to crack, so to say, and where it really depends on member states. Maybe one question here, where do you see, when it comes to market integration, where do you see the easiest, lowest hanging fruit that could be reached in the near future, where you think member states could actually come together and that will happen? I mean, is it supervision? Is it insolvency law? Is it or any of the others? Is there some sort of avenue in there where you think it's easiest to get member states going? Keep it short if possible.
No, very, very short. Any initiative in this direction, even from clusters of member states, is welcomed. So if there are group of member states that are going together in pooling them. This is already happening in Baltic states, East member states. They are trying to, because they have understood the problem, and they are trying to put everything together from their side. For us, it's fine. The more we go in this direction, the better. And then now we will see the debate in the Council with this big package on the supervision and so on. This is what we propose in December. So we hope, we will see.
Yeah, moving slow as always, but yeah, I think it's, as in many other policy fields, there's this idea of coalition of the willing, of the, differentiated integration that seems to be the way out in many ways and the way forward. And if possible, if this is a success, then hopefully other member states will follow. I think that is sort of the rationale here. And I think Spain suggested or spearheaded an effort on that as well when it comes to single market reform. I think the IPCI instrument is also a way where that could be used more for regulatory integration, maybe not necessarily in financial realm, but so there are ways, I guess. Do you want to come back on this very quickly?
If I mention this,
yeah.
We are not proposing one single place or one single model. What we would like to see is the aggregation, overcoming the fragmentation. Then, if there is one place that is better than another in a specific market segment, and another one is, for us it's okay. The point is to overcome these different rules, different way in which the member states try to maintain the situation in which the market is fragmented.
Yeah. I think another peculiarity of the European financial system, of course, is it's very bank-based. So we don't have that much market financing as the Americans have, and that, of course, it comes with some problems. But there might also be some opportunities in there if we manage to turn bank loans into something tradable. Because of course, one thing that Europe is lacking is tradable assets, and as you said, also safe assets. The whole safe asset debate, it's been there on Eurobonds level. That might come back as well. But when we talk about securitizing bank loans, securitizing also EU-backed projects, then there could be a possibility to create a market for assets in strategic areas. And this is exactly what Georg and I have been writing about also in the report. So Georg, maybe you want to come in on that and what potential you see there, but also what you think needs to be done also from the Commission and from the EIB group when it comes to creating making more securitization possible, but also creating more tradable assets.
Oh, thank you. Well, listen, it's been a long day.
I think your microphone is a bit.
I think it's on. It's been a long day, so maybe I'm sort of reading this wrongly. But I must say, so the question here is financing Europe's future and how can you get more private money into strategic investments. And I must say, I actually, from this panel, what's been said, take quite a lot of encouragement. Because I think the question of investment, in my simple mind, is about two things, and we've spoken about both. It's about structure, but it's also about signal. And what I've heard from the sort of financial participants across this table is something about signal. Victor started saying something about a once in a, I think I don't want to misquote you, but I think you said once in a lifetime opportunity for Europe. Those are strong words, really. And then you had Merete that spoke about the mega funds that is being driven forward. You say we managed the early stage, we've done that. Or sort of, it doesn't mean that push will stop. You say we're doing the tech EU now. So this is happening. These funds are being built. And then Carrie comes in, and I use the word optimism. You used the word tailwinds for Europe going forward. So here there's a bit of energy. there's a bit of energy from market participants pushing for European investments. And I think that signal question is critical. And I say so wanting to say also that this is very political. One of the things that I observed over the summer, like many, was that, was it in July that the Commission put on the table its proposal for the Multiannual Financial Framework? And that was a story, of course, of investment, strategic investment, competitiveness fund, etc. But what grabbed the headlines over the summer was obviously von der Leyen's deal with Trump, the Turnberry deal, where she did the contrary. She said, oh, look, we're underinvesting in the US. We'll be investing 600 billion now in the US going forward. That's a disastrous signal. That's the opposite than what we need to be saying, that the Commission should be saying, that the Commission President should be saying, that member states should be saying, that commissioners and national actors should be saying. The story has to be now about the signal saying Europe is open for business and we have an attractive market, we have attractive projects, etc. I think that is the first point that is very important. And I must say I take a lot of encouragement from what was said, but also let's sort of read the fine print. One of the things you said, Carrie, was about corporate investment. You know, it's low, it's not happening, they're saving. So then we need to talk about the animal spirits in Europe's corporate fleet. You know, the people who want to do something. And I think there are examples there that we need to bring forward when we talk about investment in Europe. I mean, well, ASML, it's an often taken example. We're in a new geopolitical, geoeconomic environment now. But one of the things I've noted is ASML that used to say, oh, we have this part of the value chain. We're really good at extreme ultraviolet light lithography. And that's what we do. And that's what we will do. And that's how we will make our money. And suddenly, they see the geopolitics change, and they say, no, actually, we're going to take stakes in the AI startup here in Mistral. This is about animal spirits. And I think this is what we need to get much better at doing, at talking about in Europe. And I think, well, we're discussing over lunch with sort of a representative from the Dutch National Quantum Program, what he was talking about. Look, we have this fantastic pipeline, ecosystem of startups in quantum in Europe. But will they meet, or will they be able to go beyond Series B, Series Cs in Europe? Will they have the capital that will meet their needs? And I think this is, again, a story about corporate Europe. I think that will happen when you, for instance, have a EU sub-fund on quantum. So one needs to go beyond the scale-up fund and these kind of things. We're discussing with Cornell also in the break. The EU scale-up fund, what's it going to be? It's going to be a couple of billion. You know, that's the size of a small Chinese fund, sub-fund, a tiny one, a provincial one. You know, what China is doing is 90 billion on chips and 40 billion on, on batteries and so on and so forth. The universities have these funds. So what we need is more ambitious at the level of the EU, and it's not as if that money can't be financed. EU level. If one wanted, for instance, to raise debt and say we do sub-funds on specific technologies and do it. And then one needs to have the animal spirits from the corporate Europe. And then I'm talking about, yes, the ASAPs and the Siemens and the Bosch, and why not the Equinor and the Novo Nordisk can say, well, actually, quantum is part of our future too. So we're going to put some money into that. That's, I think, is the Europe's investment story in terms of signal and spirits. Then to the structural questions. Of course, there are structural elements. And you sort of try to tease out of Laura, what's going to be this? Well, you said the low-hanging fruit or the silver bullet. I don't think there is one, and I don't think it's tweaking MiFID that's going to make a big difference here. It needs to be done. It takes time. You say it's slow. These kind of things. We shouldn't discourage FISMA, but this is not the real big game in town. I buy quite a lot into the story of, I can't remember who said it now, about this being about supply and demand. And I think the securitization point you are making, and that's also is an important one, and that makes the link with what we were discussing previously in the previous panel, which is if we are going through InvestEU to put a lot of money into projects in Europe, so for instance, giving loans to companies, Well, why are we not then, at the same time, when these loans that are relatively secure because EIB will not do foolish things, once we have that loan portfolio, why don't we pull it together and securitize it and offer it on the market as not sort of ECB type safe assets or government bonds, but highly tradable, relatively safe assets. And this is about sort of the ecosystem story you're saying. Well, if the problem for Europe's housing crisis is that too much money is going into property investment, well, then you have another form of asset class, tradable assets in Europe. So yes, one does need this securitization platform, this capacity of transforming projects, financing of projects in Europe into securities. It doesn't mean one goes all the way to what happened in US subprimes, etc., but having that spirit of more financial engineering, doing more out of everything that is happening. So I think these are the critical aspects that one needs to really get going, that I spot from this conversation, both now and in the previous panel.
Thanks. So yeah, very much the signal part I thought was quite mobilizing here. I mean, how do you create those animal spirits though? How do you do that? I mean, how do you get all these companies? They have so much capital, they don't invest. Anyone who wants to come in on that? Maybe Carrie.
I mean, Victor, because how do you? I saw you reaching for your microphone.
Georg was talking about ASML and Mistral banding together, jumping at the opportunity. How about how do you create? I mean, this is also about sovereignty in some ways. I think what Georg was alluding to. Is it more state intervention we need for that? Is it more sort of content requirements? Is it more, investment in strategic areas where that can sort of smoothen the way, or can the animal spirits do this alone? Is there, and what do we need for them to be unleashed?
I can make an honest stab at that question, but I think it's a very big question and one that doesn't have a single answer. I mean, I think as you look at innovation, there's probably not one single form of innovation and investment around innovation sector by sector. It looks really different according to whatever value chain you're innovating and investing in, right? I agree with a lot of what Georg has said, and if you look at sort of some of the sentiment shift around Europe in the last year or so, I think it's clear there's been sort of, what you'd call in markets a re-rating of a lot of European companies in terms of how the market looks at them from a forward valuations perspective. I used to hear a lot a year or two ago that there was this sort of like inherently unbroachable sort of valuation differential between European companies and American companies that was a function of capital markets. I've always been a little bit skeptical of that. And it's interesting, you either have really good eyesight, Georg, or we were on a similar sort of wavelength this morning, but I was looking up, just for the sake of it, I looked up ASML and sort of how they trade at what multiple today. And it's basically about the same multiple as NVIDIA trades at. And it's actually even less on a forward price to earning basis. So like this idea that European markets are incapable of valuing forward transformation and forward innovation and the potential for future earnings growth, I think is certainly proved wrong in at least that one case. I mean, do it in broader scale. I would flip that back and say, the more time I spend with the Draghi report, the more I come to appreciate it. The more time I spend with the Draghi report, the more I come to appreciate it. It's a really impressive snapshot of where Europe stands today on a lot of fronts. And I think, as we're often want to do in sort of both this town, but also the way the world digests information these days, when it kind of came out, the things that everyone was probably like me, where you went to the part of the Draghi report that was most relevant to you and your sector, and you said, do I agree with that or that or that or that or that? And then you probably read some of the headline numbers of, wow, that's a really big number. And I think that a lot of the discussion got absorbed in those sorts of, big, headlight moments of digesting it. But I do mean that. Like, the more time I spend with it, I find a lot of really wise framing of looking at the European economy and how we've gotten to where we've gotten to, how we should look at ourselves and how we should think about, forward adaptation. And the one thing that sticks with me is Draghi talks about this mid-tech investment trap. Is that what it says? I wrote it down, so I should be more precise with my wording when I'm middle technology trap. So as part of this report, I was looking at sort of just R&D spend and how it breaks down. And Europe, in both absolute and relative terms, trails the US and China in corporate R&D. Again, laid bare. But also if you look at sort of the shape of it, it really lags in sort of high-tech R&D spending and sectors. So that is exactly what Mr. Draghi says it is, which is a sort of both a cause and effect. It creates this scenario whereby you are locked into a low investment, low innovation cycle that then becomes more important to your economy than it is to some of the economies that you may see yourself as competing against, right? So the example that he draws out is that 25 years ago, the top 3 companies by R&D spend in both the US and Europe were car companies. Flash forward to now, and in the US, those are tech companies, and in Europe, they're still car companies. There's nothing against car companies. Car companies are great. But if we're talking about sort of economic transformation to the level that Draghi is talking about, it's clear that we need to be talking about innovation throughout all of the different industrial supply chains, value chains, innovation chains, possible. So today, when investors have started to look at sort of the change in Europe, a lot of it does come down to tone. I think that global markets are absorbing that kind of change in tone of at least the diagnosis and the clarity of purpose of how that transformation goes. But I think if you look at sort of how some of the sectors in Europe have re-rated, it's really clear that a lot of that's been taking place in financials and in defense companies. So, I mean, these are 2 sectors that have really clear sort of external stimuluses that are changing the value proposition. And it's not as widespread through all of the rest of the European economy as it probably could be, but there's momentum there. And I think that what happens next, again, is not going to be driven by sort of investor appetite in the listed markets, right? About how you value a company that's already listed. It's going to be changed through this demand impulse for capital. It's going to be changed in how companies and sectors in the European economy adapt to the changes and opportunities both within Europe and in the rest of the world to navigate what are ultimately some really, really, really fundamental structural changes happening in the global economy today.
So I mean, you point rightly at the sort of mid-tech technology trap. So in a sense, we're producing more or less the same things for 100 years already, but we just incrementally improved them a little bit. And so the real entrepreneurial or sort of the risk-taking spirit again, I think that is something that is lacking, if I understand you right. But again, how to stimulate that? I think that's an important question. It might be also a cultural question. It's a bit of a soft question, of course. Do you want to come in?
Yeah, no, that resonates extremely well with me, everything you said. And I think if you look at in the US, right, with the Mag 7s, the largest tech companies in the US, most of the value creation has come from this big paradigm shifts, whether it's mobile, cloud, and now AI, right? And that has required massive investments over a very long period of time before they translate into actual enterprise value for those companies. So I think my takeaway from this conversation is also like scale really matters, both on the corporate side. There aren't that many companies in Europe that could keep up with that type of capex budgets, let alone the long-termness of the R&D budgets. And you see it now only the success with cloud, with AI, but then you don't see all the thousands of experiments they've run over the last decades, right? That has been a failure. So allowing for those deep R&D budgets to experiment and innovate long term, I think is really critical. And then from our perspective on the investment side, scale also matters because scale allows you to be sector specialized. And I think that's also something we discussed and also in the previous panel in terms of having the capabilities to go extremely deep and become relevant and not only become dumb capital to those companies you invest in, but really a value-add partner. You have the sector expertise, you have the capabilities internally to actually change the trajectory of those companies and be an active owner. So from that perspective, scale also matters, and I think that's why the initiatives around the mega funds should be applauded, and it's really important.
Thank you very much. I think we're coming towards the end. We might do a few minutes longer, but okay, Laura, you want to come in? Keep it short, please.
Very shortly. I believe that we should make an effort to look at the European landscape from a European perspective. We are not US. Not one language, not one government. It's a little bit more complicated to imagine to have a similar big scale in a similar way. How we can do it in Europe? Not simply, look at this, why not we do this? It's a little bit different. Just to give you an example, I discussed several times with a US counterpart, and in case we have a problem in Europe, who will put money to save? A bank or a big insurer that could create a systemic problem? In US, you need 24 hours, one decision, and a capacity of financing it endlessly because of the dollar, because of the capacity of the Federal Reserve to inject money without any limit. In the other side of the Atlantic, we are not in the same situation. We need to convey capitals. We need to discuss with member states. We need to find the money to save in case of problems. This is the reason why we need to have a more prudent approach compared to our friends in US, because the structural situation is not exactly the same. So this is from one side. From the other side, clearly we have to work more on equity to finance long-term investment. But the question of equity is not only the provision of money, it's also the capacity of attracting the equity, because we need also to discuss with industrialists and to understand if they want more equity or more loans from banks. Because if they do not like too much equity investment, because they do not like too much to have another one to which to take decision, this is another cultural problem. So, as you see, as you said, it's more complicated than solving one single point or another single point. Thank you.
Yeah, thank you. I think the financial stability aspect is important to mention here when you talk about allowing more risk. And yeah, I think there's a lot of those hidden champions and family companies that don't exactly like to share equity and issue equity. So really, Europe is quite different from the US. Merite?
I wanted to come back to the question of how do we bring in the large institutional investors that you were mentioning in the beginning also, because you have to ask yourself, why would they want to come, and a pension fund, an insurance company, why would they come and invest together with us as a public investor? They need incentives, of course, but they are looking at the diversification that we can offer in terms of strategies, the strategies that our funds are following, in terms of geographical diversification as well, because we cover typically pan-European or at least pan-regional. And then also they are looking at returns. We know that. It's your clients, our clients. And actually, we have a very nice, a very cool cooperation with BlackRock, because we have made available to everyone to have a look at the performance of European VC in the last 10 years. It's data that we have from our portfolio of 1,200 funds together with BlackRock. And if you go into there, you can convince yourself that actually in Europe we have very, very good investment propositions as well. So these are the things that they will look at. But Then it's also, of course, important for them how much capital will we have to set aside because of the regulation, and that's why we're so satisfied with what Laura was saying earlier, is that now under the capital requirements regulation or the second line regulation, and also under Solvency II, which is the regulation for the insurers, our programs such as ETCI are being recognized as legislative programs, which means that the capital charges for these investors are reduced. And this is extremely, extremely important for them and for us. Now, to borrow a phrase from Sophie, who just left, she said implementation is key, and this is also the case here. So this also needs to trickle down to this fact that when private investors, large institutional investors, come in together with us, they have a risk reduction. This also needs to trickle down to the regulators, and that we haven't fully seen yet. It takes a little bit of time, but I think this is a job also for the organizations, the associations like IOPA, the Association of the Insurers, or even the EBA, the Banking Authority, to tell the national regulators that this is actually something that has been given the stamp now as being something where even pension funds that, of course, needs to be careful with his investments can come in. So this is for me extremely important. Now, the scale-up fund, it has been mentioned several times here, but of course the service and the commission who are responsible are not here. But I see it as an extremely good complement to what we have been doing with the ecosystem building over the last years with our general VC and private equity activity, but also now with the Tech Champions initiative, because basically what the commission is saying is that we want to invest into a fund that has an investment strategy which serves our purposes in terms of areas, the tech areas that they want to invest in, but also economic security. And that fund will then invest into a number of companies that fulfill the requirements in the investment strategy. And this is very much basically what the funds are doing that we have under ETCI. So it's another, let's say, philosophy. It's about direct investment into companies where we have the philosophy of investing into the funds that and building up. It's a little bit like I used to say, it's about either you give a man a fish or a woman a fish, or you teach them to fish by building up the ecosystem that then can function on its own, you see. So I think these two initiatives are very complementary, and we're looking very much forward to seeing it being materialized.
And yeah, so are we. And I think it's interesting how you spelled out again the complementarity of these two funds, and also, of course, the importance of lower capital requirements, and that as an instrument, also particular for strategic investments or particular EU instruments. We're now coming to the end of this, but before, I would like to also open the floor for questions to the audience. So if there are any questions, please raise your hand. Also online, that's possible. Just write it in the chat. I know we are already over time, so I apologize not having asked you earlier. I think the conversation was, so engaged that it was hard to interrupt. But yeah, in case there is no one who wants to come in, yeah, Cornell.
Can we elaborate more on the?
We would need the microphone as well. I don't know because otherwise the online colleagues can't hear it.
I can hear you.
But you can come and say, repeat the question if it.
So you mentioned the problems we have on the demand side. Yeah. I completely agree. But can you elaborate more on what more is needed to address that?
I can elaborate very quickly in the sense that I don't have an easy answer, and I do think that it's a multifaceted question that touches, sort of as I said, like it will have a different answer for different segments of the economy. If you look at sort of financial account balances, this isn't entirely unique to Europe, but I think it's sort of maybe more pronounced, but over a longer period of time. The one segment of the financial account balance world that is soaking up excess savings all over the world, obviously, is governments. governments are consistently in deficit. And today, those governments that are absorbing more of it are also pulling capital, I think, is a fair assessment of it. I mean, I think I like Georg's framing of it as the animal spirits, as you were, of the corporate world, which is, again, why we're having this conversation is about the companies in the European economy that drive economic growth. I think the exam question for all of us is how do we reignite that in Europe, or at least sort of increase the magnitude of tailwinds behind it?
Sure.
Studies, and I think I cannot agree more on this, and it was already alluded earlier in the panel that European growth model needs to change, because so far it was driven by exports and suppressed demand, and this is exactly what stands in the way of demand. And I was at earlier conferences, like with car producers, and they say we just don't have enough demand. So I would say now that the exports to United States, or for example German cars, or to China are going to stagnate probably or reduce. Germany needs to rethink its growth model, and I think they're moving to this direction. But basically, both private consumption and government consumption need to rise. Yeah. And on employee ownership, I think employee ownership is needed for everyone in Europe, and I think this one probably will help to increase awareness of capital investments in general.
Thank you. Anyone would like to comment still? Or comment on this? If not, I would say we close this panel. Thank you very much first to the panelists for your very interesting interventions, for the good discussion, and everyone here in the room and online for attending. It's been a day of good discussions, and it's also, as said before, it's the final conference for our strategic investment project that the EPC has been leading for quite a while, where some of the members of the task force that Fabian before alluded to were on the two panels, among them also Merete on this panel, and Sophie from Caisse de Dépôt, for example. Thanks also go out to the Caisse de Dépôt and Nysna Climate Investments for supporting this. And as said before, the report which was published in July, some of you might have read that already, is lying out there. You can read it. So with that, I'd like to close, and thank you very much again, and have a nice day.